Welcome to our presentation on auditing for public accounting. This is our first lecture, and thank you very much for your participation. Our first lecture is going to provide a framework for our understanding of external auditing, and in fact our first learning objective is to define the objectives of external auditing and describe its role in meeting society's demand for reliable and internal control information, for reliable financial and internal control information. One of the things that we want to talk about in regards to the external audit process is to understand where the external auditor fits in relationship to the organization as well as society as a whole. What you see is that the auditor frames a very specific position within the relationship between the owners and the agent managers. Agent managers are responsible for the organization, and through the financial statements, managers are able to communicate to the owners as well as other external stakeholders in the organization the financial position of the organization. Now, given the fact that the information may in fact be biased without an intermediary, the role of the auditor is to provide an external objective review of the financial information so that those people that are actually reviewing the information are able to look at this and say this is a fair presentation of the financial position of the organization. External auditing, the objective of external auditing is to provide an opinion. So you notice the key word is that we are expressing an opinion. And what are we expressing an opinion of? On the reliability and fair presentation of the financial statements. Our opinion is intended to enhance the confidence that a user can place in management prepared financial statements and on the effectiveness of internal controls. You notice this, and I've highlighted a key point here that's in red. Sometimes the auditor will also provide an opinion on the effectiveness of internal controls over financial reporting. During this course, we're going to talk about an integrated audit. An integrated audit is where the auditor not only expresses an opinion of the fair presentation of the financial statement, but the auditor also expresses an opinion of the internal controls over financial reporting. We're going to find out specifically when an integrated audit is required, also when it's not required, and understand how all of these pieces come together in terms of looking at internal controls and ultimately expressing an opinion of the financial statements. The end result in the audit is what we call the audit report. Now, we use the term unqualified when the auditor issues a type of report that implies that the auditor has no reservations about management's financial statement or the internal controls. This is the most common outcome of the audit, and this implies that this is a clean report. We use the term unqualified because what we're doing in an unqualified opinion is we are expressing an opinion without qualifications. What I have here is an example of an unqualified opinion. Now, this is something that you will actually need to understand at a very deep level as you're preparing for the CPA exam. A couple things that I want to point out to this is you notice that this is a report of the independent registered public accountant firm, and the report is addressed to the stockholders of Earthware Clothiers. So it's reporting to the stockholders. The key point is that the auditor does not report to management. The auditor reports to the stockholders, and we'll find this out from the perspective of the reporting directly to the audit committee, which is a part of the board of directors. We have an introductory paragraph. In the introductory paragraph, it identifies two key elements. You notice it says, these statements are the responsibility of the company's management. So management is responsible for the financial statement. Our responsibility as an auditor is to express an opinion of these financial statements based upon our audit. The scope paragraph defines the scope. It defines whose standards that we're using. In this case, we're using the standards from the Public Company Accounting Oversight Board. It explains that these standards require that we plan and perform the audit to obtain reasonable assurance about whether the financial statements are free of material misstatement. Key word here is reasonable assurance and free of material misstatement. These are terms that we're going to define very shortly in our lectures. An audit also includes an examination on a test basis. So it's basically telling the reviewer or the reviewer of the financial statements that we did not look at all transactions. We looked at transactions on a test basis. It also defines the fact that we considered the accounting principles, and all of this together provides the basis for our opinion. The opinion paragraph that we see down here, in our opinion, the consolidated financial statements referred to above, and the key phrase here, present fairly in all material respects the financial position of the company as of December 31st. And then finally it continues, in conformity with U.S. generally accepted accounting principles. So the basis for our opinion is how the financial statements compare to generally accepted accounting principles. In the last paragraph, we're actually providing an opinion of the internal controls. And again, the internal controls is part of the integrated audit that we will describe later, is mandated by Sarbanes-Oxley. External auditing, a special function. We need to understand that the public has expectations in regards to auditors. So when we receive our CPA license, there are expectations the society has in relationship to what we're doing. There's the expectation that we find fraud. There's the expectation that we require management to use accounting principles that best portray the spirit of the concepts identified by the auditing standard setters. We are expected to be independent of management. We're also expected to keep fees down, to make careful decisions, and to conduct a quality audit. The key word here is unbiased reporting and independence. So why is there a risk that the information provided by management may not be reliable? Well, there's a potential bias by management. There is the remoteness of users from the organization. And the primary issue is certainly going to focus on the complexities of transactions as well as processing systems. And the issue from a management perspective, if financial statements are not reported correctly, there are severe consequences. Investors are making their decisions based upon what these financial statements say. Banks, reporting agencies, the government, the IRS, everybody is looking at these financial statements as a fair presentation of the financial position of the organization. And if the information is presented in a biased way, these decisions are not going to be made appropriately. And again, the consequences can be very severe. So that is where the auditor comes in. We are examining these financial statements to express an opinion of the fair presentation. Keep in mind that we are not expressing an opinion of management. We are not saying management is doing a good job or a bad job. Is all we're saying, you look at the financial statements, and those financial statements present what the financial information is based upon generally accepted accounting principles. During this course, we're going to be talking about how we actually come up with the opinion that we end up with. And the book is actually presented in such a way that we can understand this in a very systematic process of getting from the audit engagement to finally expressing an opinion. So you notice here that we're going to talk about how we actually create an engagement with an assignment. The key point here in the second section is performing a risk assessment. One of the very interesting things related to auditing is that we audit based upon a risk perspective. Now, when we talk about risk, we need to think about risk from the perspective of what can go wrong. Doesn't necessarily mean that something has gone wrong, only that something could possibly go wrong. Well, once we've identified what could go wrong, we're going to obtain evidence related to internal controls and operating effectiveness. So you notice we do a risk-based assessment. We then test the internal controls. The internal controls are essentially what management has established in terms of preventing these bad things from happening. Now, based upon our risk assessment and our understanding of the internal control process, we will then develop testing where we are measuring monetary misstatement. So in section 4, you notice it says that we will obtain substantive evidence about accounts, disclosures, and assertions. This is a substantial part of this course, and the point that we want to make when we start talking about substantive testing is we are actually testing transactions and account balances to determine whether or not these are reported appropriately. Or as we had talked about earlier when we were looking at the audit letter, are there material misstatements in regards to these account balances? Finally, we're going to complete the audit in section 5, and we need to understand essentially the other framework that becomes a part of this. We need to understand the audit profession as a profession, risk of fraud, the mechanism in terms of addressing fraud, regulations, corporate governance, and otherwise. We also need to understand professional liability and the need for quality audit judgments. And finally, we need to understand how we come up and formulate the audit opinion based upon a very specific framework. So when we talk about the audit, we need to understand that there are very specific parties that are involved with this. So within the organization, again, we need to understand that management is responsible for the financial statements. So management maintains internal controls. They're responsible for internal controls, and they prepare financial statements. Management has or should have established very specific control mechanisms. We'll talk about internal controls quite substantially in this course, but the one piece that we talk about in this slide here is the internal audit function. The internal audit function provides internal assurance on internal controls and various reports. Not necessarily the financial statements, but certainly the effectiveness and the efficiency within the organization. We had mentioned earlier the audit committee. The audit committee is part of the board of directors. Now just make sure that we understand this, is that the owners are separated from management. The owners vote on a board of directors. Within the board of directors, there's various subcommittees. One of the subcommittees is the audit committee. The audit committee is responsible for providing oversight of the reporting process and of other parties within the internal control process. The financial statements and regulatory disclosures along with the audit report is disseminated to users. And you notice how that in the middle here we have the financial statements. The financial statement is coming from management with the audit committee oversight. The external auditor is providing a oversight from assessing internal controls, and measuring monetary misstatements in terms of transactions and account balances so that the auditor can then express an opinion. And again, the unqualified opinion is the opinion that the financial statements present fairly in all material respects the financial position of the organization according to U.S. generally accepted accounting principles. So we have a very brief overview of the auditing process. We're going to have many other presentations regarding the audit process, but I wanted to at least get us started in terms of the discussion related to external auditors, what their role is, how the financial statements are the responsibility of management, and how the external auditor comes in and as an independent expert that understands auditing is able to express an opinion. And again, the opinion is not an opinion of whether or not management is doing a good job. The opinion is on the fair presentation of the financial statements. So a user of the financial statement, whether the user is an investor or another stakeholder, can take a look at these financial statements and can have some assurance that these financial statements represent in a fair way the true financial position of the organization. So I thank you very much for this, for the time that we've had, and look forward to many other presentations regarding the audit process.